Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. This time we're diving into American Shared Hospital Services annual report. Let's see if this is a healthy company or one that needs life support, but don't worry, no actual stethoscopes will be used. The report covers everything from what the company does to the risks they face, and of course the all-important financials. American Shared Hospital Services, or ASHS, provides equipment and services for radiation therapy and radiosurgery. They lease out equipment to hospitals and also run their own treatment centers. Basically, they're in the business of helping cancer patients get the care they need. Let's lay the groundwork. This report is a Form 10-K, which is like the annual checkup for publicly traded companies. It gives investors a deep dive into the past year's performance, risks, and future outlook. Think of it as more than just numbers, but as a whole story. Before we really dig in, there is one number that catches my eye, and it says the market value of the common stock held by non-affiliates of the registrant was approximately $15.9497,000. This number tells you how much people value this business. Keep this number in mind for later when we get to the financial results. First, we need to talk about those forward-looking statements, a standard part of these reports. It's where companies make educated guesses about what's coming next, but they also have to let you know that those guesses might be wrong. They use words like believe, anticipate, and expect. There are quite a few risks that may make future periods differ materially from those expressed in any forward-looking statement, including restrictions in our debt agreements that limit our flexibility to operate our business and technological advances and the risk of equipment obsolescence. American Shared operates in two main ways: medical equipment leasing and direct patient services, like their own clinics. They've been expanding, acquiring facilities in Rhode Island and operating a new one in Mexico. They're also involved in proton beam radiation treatment system in Johnston, Rhode Island, with an expected first patient treated after 3 years. And big moves happened in May when ASHS acquired a 60% stake in 3 radiation therapy centers in Rhode Island. Then in July, they started operations at their own linear accelerator facility in Mexico. All of these moves have been attempts to diversify their revenues. Looking at the numbers, Gamma Knife Services brought in about $9.7 million, which was 34.3% of ASHS's total revenue. It's worth noting that it was 51.5% last year. If the company fails to successfully diversify its business model, its revenues and profitability may decline. The company's stock trades under the ticker symbol AMS for American Shared Hospital Services. The company's customer base is concentrated. 2 customers accounted for approximately 35% and 27% of the company's total revenue in 2024. To finance their operations, the company has some serious debt. They have a credit agreement with Fifth Third Bank. They've taken out additional loans, and they also have a loan with the United States International Development Finance Corporation. The amount that Medicare pays for their treatments is obviously very important for the company's revenue. The average Medicare reimbursement rate for PBRT, that proton beam radiation therapy, ranges from about $578 to $27 per the 76. Per day for the RO APM is proposed. CMS will provide at least 6 months notice in advance of the proposed start date, and the proposed start date will be subject to public comment. Because this is the healthcare industry, legal and regulatory compliance is another key piece. They have to comply with anti-kickback statutes, physician self-referral bans, and regulations around radiation sources. Any slip-ups here could lead to big fines or even getting kicked out of Medicare. Let's move on to a more serious section. There are a lot of things that could hurt ASHS's future. Changes in government regulations, the debt that they're carrying, a limited market for their services, and competition. There are just so many. The company is vulnerable to pay or mix variability, which could negatively impact the company's revenue and financial results. The success of the business is directly tied to what insurance companies are willing to pay for gamma knife and radiation therapy treatments. Due to the lack of reliable financial information for the Rye companies following the protracted bankruptcy proceedings, the company is not able to obtain financial information sufficient to be able to provide the SX financial information. This could hurt their ability to raise money in the future. The company also faces cybersecurity risks. A data breach could damage the company's reputation, and it's not cheap to fix these things. We see they have a significant potential problem with their equipment. The auditor, Moss Adams LT, calls out some critical audit matters. For example, the estimated reimbursement rates and assessing the value of business with the reacquisition and the impairment of property and equipment. Auditing management's judgments used in the estimates of reimbursement rate involved a high degree of auditor judgment and subjectivity. That's never a great sign. The trading volume of the company's common stock is low. Time for the numbers. Total revenue in 2024 increased 32.9%, primarily due to new revenue streams from Mexico and Rhode Island locations. But expenses have gone up, and the company recognized impairment on 6 of its domestic gamma knife units. Proton therapy revenue was just under $10 million, a slight decrease from last year. Gamma knife revenue was $9.7 million, a decrease because contracts expired. The standalone radiation therapy facility in Puebla, Mexico, and the 3 standalone facilities acquired through the RA acquisition were $8,500 to $117,000 for the year ended December 31, 2024. Costs of revenue jumped almost 60%, mainly due to those new facilities in Rhode Island and Mexico. Interest expense also rose because of more borrowing. The loss on the write-down of impaired assets more than tripled, and the company recorded a $3.7 million net bargain purchase gain, largely offsetting all the bad news. American Shared Hospital Services took home a net income of $2,186,000 compared to $610,000 last year. Cash flow looks a little weak. On the cash flow side, they used a lot of cash for purchases. The credit agreement contains customary covenants. They have to be in check with their ratios. The company is committed to purchase and install Gamma Knife and Lean-Ach equipment for $13 million. In terms of leadership, there's been some shuffling. Raymond C. Stachowiak has been the executive chairman of the board, and Mr. Gary Delanoise was appointed as chief executive officer of the company on April 3, 2025. They even have a policy on inside information and insider trading because, of course, they do. So let's wrap things up with my opinion. It's a mixed bag. Revenue is up, but so are costs, and the company recorded debt. On the other hand, I think this company's management is good and they're actively trying to diversify their company. Overall, ASHS is a company at a crossroads. They're trying to transform from a business focused on old machines, and they are trying to look to the future of medical business. And thanks for watching. If you enjoyed this video, please consider subscribing, liking, and commenting.